doesn't know me, I'm Litan Yahav. I'm one of the co-founders and CEO of Vyzer. My good friend Mike Arndorfer is with me here on these calls. Mike is also another group I'm part of called GoBundance, and we're both LP investors. We've been investing for a while, and we've been doing a bunch of things together. And I was really excited to launch these calls and have Mike join me to give me some critical discussion, conversation, some feedback, just have an interesting conversation. And so, as I mentioned on previous calls, this is not a webinar style, it's more a conversation. And I'm really going to emphasize and encourage everyone to just participate, because if there's things you don't agree with or you have questions, I want us to have a conversation around them as we did on our previous calls. This call is the last call of the year. It's only our third call, but we're going to end it here before the holidays and then kick it off again January 8th. I'll be sending out invites for that. And this call, I thought it'd be interesting to go over some data. So Vyzer, as you guys know, helps people track and manage their entire wealth. And we have this huge aggregated, anonymized data set that people have been asking, well, what are we seeing in terms of trends? Where are people allocating or not allocating or moving money from one to the other? And so I thought we'd spend some time today to dive into that. And also some feedback that I got previously on the idea of this call. It's a 45-minute call. And the thought was first 10 minutes to do some market recap. Now, not every week there's a lot of interesting things to talk about. And I am curious if there's anything specific you all have top of mind that either have happened in the markets the past week or are going to happen in the next weeks that we can sort of do this cadence. So for example, the past week, the only really interesting thing that happened in my mind is what happened this morning, that the actual inflation rate is 2.7%, which is below expectations. They were aiming for 3.1 and it's 2.7. And that might say some things about the economy moving forward. Fed will probably not do anything by the end of this year, but maybe next rate cut might happen or not if this stays the same trajectory as where we're at the moment with inflation. Mike, what do you think? What do you think the inflation means or not?
Well, I think it gives the Fed more room if they need to do something. I don't personally think that they're going to do much unless the labor market starts to really come apart more. I had more to sense with the last meeting than we've had since I think like 2019. One guy who's gunning to get the Fed job from Trump that said 50 because he's just a cheerleader and going to say 50 no matter what. But there were ahead of time, there were up to 5 people that were saying no rate cut needed. And Powell got, I think it was all but 2 of them to come on board. Yeah, 3 of the 5 came on and voted for the quarter point, but he also then was saying, it's coming. So the biggest, I don't know if it changes much, but it gives the Fed more room that if it feels like jobs are falling or there is problems with the economy, that they could do something. Because that's really, Fed has brought the federal fund rate down 175 basis points since started cutting, and the 10 years gone up 40 basis points. And so it's one of those things where traditionally you get the situation where you cut and interest rates go down across the curve. And there's really been this thing where they can control the low end, but they haven't been controlling the high end. Now they've stopped quantitative tightening, so that maybe will help more and they can go into quantitative easing. But long way of saying, I think it gives them a little more room if they need to do something, but it doesn't change anything in the short term.
Jay, what's up, buddy? Welcome to the call. I'm sure you have a lot to say about that as well. I don't know if you want to chime in.
Hey, thank you for having me. No, I'm just happy with the 2.7. I'll take it. We'll see what the Fed do next month.
Okay. You can chime in as well if you want to sort of share the insight. You just wrote in the chat important factors that drop energy prices and stuff like that, right? You want to share a bit of the background about that?
Sure. It exists and it propagates because energy is everything runs on.
But why is the inflation directly related to the energy prices?
Energy costs are essentially going to be built into almost everything we consume because all the goods get moved using fuel.
Yeah. So also, what people notice, I think Trump is going to put extra pressure to try to keep energy prices down, at least until the midterm elections, just because he wants to feel people to feel like things are under control. Because that you pay $55 to fill your car or you pay $40. That's something you notice once a week, and it's only $15, but it feels bigger than that. And I think that the massive voting public, the things that they can really pay attention to. And so I think he's aware of that. which then from a investing perspective, I've been looking to get into oil and natural gas for a while. I don't have any exposure to it. I found a couple of things that look interesting, but I've actually just sort of back because I'm like, I don't know, is now a good time or not? Or should I wait another months?
But around the conversation of inflation, isn't energy the driver of an inflammatory or the opposite
Well, like I
environment?
said, it's in everything. Everything gets costs get factored into everything you do, and I'm a factor for sure. In sort of across the board. So
Right, but
that's
just
why.
what I meant is the energy affects the fact that there's inflation affects the prices will go up or down. I mean,
Correct.
yeah. All right. So awesome markets and some conversation around that. I'm going to dive into the trends, Vyzer, and then we'll open that up to conversation because I'm sure that there's going to be a lot of sort of feedback. I'll say it loosely on what we're going to show. So I'm going to share my screen here. And again, feel free to chime in if you have any insights or questions. So what we've did basically is we've taken you can see my screen, correct? What we've done is we've taken basically the data that we have Vyzer and sort of taken it from the past 5 quarters, 27,000 transactions, roughly 2,500 investors, and we have $24 billion currently tracked on Vyzer. And so that gives sort of holistic insight into the deployment of capital and asset allocation. I will say it is important disclosure. Our product is very skewed towards people that are invested in the private markets, specifically in equities. And this, just like any other survey you'd see in any other community or asset allocation report, it's very skewed to the audience that it's based on. And so for us, I just put that as a side note and keep it in mind as we dive through the data points. So first off, looking at the highest level of asset allocation, and just look at the public markets versus the privates and cash, and we compare it from Q4 of 2024 to Q4 of 25, we've seen a substantial increase in allocations to the public markets and a decrease, obviously, in the privates. Cash more or less stay the same. And again, there's factors that can be taken into account to this increase and decrease, or mainly the increase. Number one, it's possible that the public markets just went up and that increased people's allocation to the public markets. That's one factor. The second factor is people actually deployed more capital into the public markets. And obviously there's a blend of the two, which probably is the reality of it. I don't know what Mike think about this. Any sort of insight on that?
Well, I think it's both. I mean, I don't know, call it 17% in the last year. So that would take it from the 27% to, and then I think the other 4% of that is I'm hearing more and more people that are just investing in public markets. And I personally don't agree with their thought, but the thought is, hey, private have been having their ass kicked, losing money in different things. Oh, I should have just stayed in the public markets, been going up every year. And that's so this mentality of like, okay, alts are bad. They're not doing so well. I'm going to not put more money into them. I'm going to maybe, if I get anything back, I'm going to put it towards the publics. And what I would say that I think everyone should think about though, is it's like the public markets are at all-time highs and everything's going great, which is maybe that continues. But my personal opinion, when I look at historical data, when we are at PE ratios where like we are right now, there's never been a time in history where 10 to 12 years later, up another 100%. It's always been something where, you get these really high expanded PEs. And then I don't know what it looks like. Maybe you go up another 50% before you go down, or maybe you just grind sideways, or maybe it goes down and then up, or who knows. But usually you're in a range of a few percent per year, up or down from that. And you are unlikely to continue to have 15, 17% returns over the next 10 years.
Yeah, and I know you personally don't really like the public markets as much, right?
No,
So
I have zero exposure. So yeah, I'm biased. Certainly.
yeah, so put that as a side note. And then if we dive deeper, sort of how it has evolved over the past 5 quarters, this is when I saw this, I was really, we sort of see a flip in new allocations or new investment activities in these different. So before, the slide before was just the actual asset allocation and how the allocation itself has changed in people's portfolios. This is actually new investor dollars each quarter and where they went into equities or debt, privates or public. And so all the blues are basically equities, and all the greens are debt. And then it's split between public and private equity and private debt. And you can see last Q4 24, it was the opposite on Vyzer. Sort of 60% of every dollar spent went into private investments, private equity. And we'll talk about what that means exactly, but private equity investments versus public equities, 37%. It flipped. So Q4 this year, 60% of every dollar deployed went into the public equity sector and 34% into the public equity. And it sort of helps give more color into why that increased in our user base's allocation. It's not just because the markets went up, but it is also because people actually deployed much more capital into the public markets, again, predominantly public equities. And again, our audience is more skewed to equities. As you can see, the debt portion of a portfolio or of an allocation into a portfolio has been substantially lower than equities. 94% of every dollar went into equities, only 6% into debt. So also sort of adding on to that notion that public markets have become more attractive for investors to deploy capital into. Not to say what's going to happen in the future, but just like that's what's been happening over the past couple of quarters. And then within sort of the debt, because I think it's important to talk about that for a second, because a lot of us investing in the private markets have heard about private credit, private debt, hard money lending, all the world of sort of private debt has actually went down substantially over the past 5 quarters. And here's sort of Mike and I were talking about earlier. It's more philosophical because you'd say what 77%, it went down from 175 to 0.4. That's only whatever 1.2%. So the way I see it, it's look at it not as like how absolute percentage, but what is the actual change. So it's just like if you buy a product for $1 and the next day you go in and it costs $2, it's not just $1 more, it's 2 times more expensive. And so again, when we look at new investment activity, there's 77% less activity of assets of capital deployed into private debt. I thought was also interesting because debt products would assumingly be more attractive, aren't as attractive as they used to be. And people aren't deploying as much capital there. And it probably might also be because the public debt might be more interesting for people. I don't know, Mike, what do you think?
Yeah, I was surprised at how low this was, and it's gone down. With the people I talk to and the coaching clients that I have, I'm actually seeing more allocation to private debt. And so again, I'm 2,500 people. I've got a very small sample size by comparison, but I'm seeing more people that are saying, "Look, I want to kind of keep on the sideline. I think there's going to be stuff available," and kind of think of stuff in different ways. Like is your like a high savings, that type of thing. And then, the hold of that day or within a day or two. And then there's some of the things that are private debt where you can get into 30-day, 60-day, 90-day liquidity and, still somewhat available, but not quite as quickly as the other. And I'm at least seeing more people allocate there as sort of a holding period. They kind of see and not necessarily take the risk yet. So I was surprised by the data, but beautiful about Vyzer. You have so many clients all across the country, and it's a $10 million average ticket to have of your investor. You got people that are 100 million, and you got people that are a million. So it's your data.
Yeah, and it's up to that, right? That's why I mentioned at the beginning as well. Jay, a really good point what you wrote in the chat about sort of publics, and we had a conversation about this on the first call about sort of defining this and how to compare it to liquid assets. And I agree, treasuries and bonds tend to be very similar to cash. But either way, it's such a small allocation, both on the deployment standpoint and on the asset allocation standpoint, that I'm not sure it really matters as much. But I agree, it's important to sort of take that into account when we think about it.
Yeah, and I agree, Jacob. That in my mind, I think of something that I can get a hold of in, say, like 3 days. I consider that cash. Essentially, it's something that you can probably get a hold of fast enough. Other people don't, and there's no right way to set it up. But yeah, you can liquidate today, put it in liquidate today, have it clear tomorrow, and then send it to your bank account that you can have it by the next day. I would that cash also.
Yeah, this is a whole philosophical conversation, Mike, we've had times, right? Like I imagine I have a house and I put on the market for a 50% discount, I'll probably sell it within an hour. And so is that liquid or not liquid? I mean, Yeah. Let's move here. Okay, now go into the private side of it. That's because where Vyzer's, strengths are, where I think it's most interesting because there's not a lot of data around it. And if we look at the market of the underlying assets of these privates, and I split the four main categories. Let's say we got real estate underlying asset, you got venture. Venture could be a startup, but venture could also be VC or even growth. It's to put them all in the same bucket, but just for simplicity, I just tried to sort of show here. So I put them all in the same bucket. We have collectibles and commodities. Collectibles can be watches and cars, but they can also be physical gold or physical silver. Like these are all private holdings of assets. And traditional businesses could be, cash could be an operating business that I operate. And again, these are all new deployments of capital into these underlying assets. Bitcoin is a question, Randy. I put Bitcoin as publics. I don't put it as a private investment. I think of it as public. I put it under crypto, obviously, and then I see it. The vast majority of crypto is public equity. Again, we can argue what the other asset is Bitcoin, but we can also have the underlying asset of Bitcoin being somewhere else. If I a wallet, it could be cash. So it really depends. But that's a great question and conversation to have around Bitcoin. But let's talk about invested dollars in private equities for a sec. So again, this is new dollars invested in 24 versus new dollars invested in 25. And we see we have double percentage of dollars invested into real estate versus 24 and a decrease of dollars invested in traditional businesses. This could be, again, operating businesses, cash flowing businesses, whatever it is. Jay, I'm sure you have a different insight in this because of all your background in buying and coaching people on buying cash flowing businesses. I don't know if this is sort of contradicting your seeing of the market, at least who you're dealing with. But I was really intrigued in this, and Mike and I had a conversation. Like people are investing in cash flowing businesses, then in real estate, at least that's what I hear. But then when we look into our data, it's kind of opposite.
Yeah, and it's coming. Give it time.
Okay.
Let's review it in 6 months. But there's definitely a big appetite for stronger cash flows. Obviously, because we have been high, so it kind of lowered the cash flows in real estate, and people are just they want to invest in more traditional businesses. In your is the traditional business are businesses that own themselves.
Both, but
categorize.
I put them together. I from venture, which is venture are more like startups and VC, and these are more like, again, if I'm either business to invest in it and to leverage it and flip it, or I operate my business and I have equity in that and I'm investing more, or I started a new business. Like this is where this goes in.
Jay, when I this, because Litan and I kind of went through and reviewed some of this ahead of time, I was surprised because I know a lot of money going into buying businesses and stuff in 24, but I thought that it was probably equal in 25. Are you seeing things have cut back or not?
On business acquisition? No, it's even
Wouldn't you would have guessed it was the same or like you same or growing. I would have not guessed that we would cut it to a third of the activity from a year ago.
Yeah, 26 is maybe the strongest ever. There are many funds being started now on the PE side and the VC side to go and buy Main Street and transform technology. So let me grow. Just give it time.
I'm curious if there's anyone else on the call who's sort of like, wait, hold on, but I'm really investing, doubling down on cash flowing businesses versus real estate. I'm moving my sort of there, and that's what I thought the market is going towards. Is there any sort of like more attracted to that space? You don't have to answer now, you can write in the chat or whatever, but that's just like a thought that I'd love to hear input from not just the data that we have either. And then if I into real estate, because that has been the most sort of sought after deployed asset class, the 25. This is what we've seen as trends within the real estate category. Again, these are new real estate investments during 25. And again, be surprising or not, but 56 in 24, 56% of of new investments in real estate were in multifamily. And 25, it went down 17%. So we're at 46 at the moment in 25. On the flip side, and these are small numbers again, but it's substantial because their growth has been big. Mobile home parks. In 24, only 2% of investment in real estate was in mobile home parks. Now it's more than doubled. So we're at 5%. So, and we mobile home parks, like we've talked this, Mike. There are a couple of operators that we know and have tax advantages in mobile home parks as well, and that also might be one of the reasons. But also, I think a lot of people might have been burned from multifamily, and that's why they've been moving. And then the
Yeah, the
third,
other thing I'm seeing with mobile home parks is that I think in 23 and definitely in 24, there were a lot of what I would call the mom and pop, owners holding on sort of like they didn't in 21, 22 at the peak, and they were kind of set those numbers. And I'm at least in because I invest in a lot of different funds and individuals in mobile home parks. And what I'm seeing is people are seeing more activity. There's more of the mom and pop operators are capitulating and just accepting what the reality of the market is, and that interest rates have gone up and they have to sort of program. And so I'm seeing more deals. And so because there's more deals, then you would get more new inflows into it. But I agree completely on the multifamily part. People, I mean, it's phase. I'm seeing some really strong multifamily things coming through with a few different operators, and like good and there's some bad deals out there that people are doing, but not many. But there's some really good stuff, and people are having a hard time raising because multifamily got such a bad rep, from getting into things that weren't good deals a few years ago.
yeah. Industrial is also like the third one that we're seeing also an increase from previous year, and more people have been interested in industrial funds and direct deals. So that's real estate and what we're looking at. So and
Yeah, I just want to second what was about multifamily. I'm extremely bullish this year as I've seen a lot of the prices on a per door basis has gone significantly down. And, already three deals in multifamily, and I haven't touched multifamily as far as investing since 2022. So I feel cap rates have softened, and it's definitely time for going in. So I've actually doubled on multifamily for 2025 and likely 2026. But again, like you said, good operators, very, very good.
I agree. I think to the next, 18, 36 months is going to be a great time to be deploying some new money into multifamily. As long as it's with a really experienced operator and somebody who in a lot of trouble on what they have. Because I've some where they have a good deal now, but their entire portfolio is just full of, it's fire stuff. And so I put new money with somebody who at least should be spending the most of their time trying to rescue all the stuff that they did wrong in the past. And so my personal opinion is I'm avoiding because there are other operators that didn't get into things when numbers didn't make sense, and now they're able to come in fresh and buy things and focus on the new stuff.
yeah, and we're gonna have a whole session that we're gonna talk about, specifically each of these asset classes and bring in a professional and either someone who coaches like Mike or also maybe bring in like a reputable manager who's been in the industry for many years to talk about it. So we'll do that as well. As a high level note, when you think about trends, and there's a common sort of note that when everyone's into an asset class, that's your get out, right? And they talking about buying Tesla, then that's when you probably want to sell. And so I think, and I agree, there might be a lot of opportunities now in the family space, especially because so many people have gotten burned and moving from it. And that number one means that probably the better operators are going to be the one that stay. And people like Randy, who has it easy to raise capital and he's always oversubscribed, that's awesome. As opposed to those who so anyway, that's on the multifamily side, on the real estate side in general. Now listen, when I sort of unpack that we have a lot of different rabbit holes, and instead of with endless points about fees and other structures and how we've seen this and that, I thought we'd put together a report and we'll just share it offline so you guys can review it, and we can spend the next 10 just like talking about that you all think would be interesting to look into the trends, and based on the data that I showed, the high level, what would be interesting for you guys to know? Like, is it deeper into multifamily, understanding where in specific in multifamily, or is it a specific different asset class, or maybe public markets and like which equities are people buying? Is it equities, is it bonds? Which T-bills are through other? So there's so many questions we can ask about our data set. I don't know, Mike, what do you think would be top of mind that would add into this report?
I don't know. I mean, I hear from the group, things that I look at, but
Well, you don't have the public markets as much, but and so
not as much. Yeah, not fun.
and And all right, comparing IRRs and MOICs, yeah, we can unpack that as well. It is the thing about
related to be because I know you guys get the initial of what the projection was, the IRR, when there's going to be and that kind of stuff. It'd be like, I would think it would be interesting to see some of these things from, the data on from 2021, 22, where are them? What is, I mean, because especially with multifamily, lots of pause, lots of, cash expected to be 6% and it's been paused for a year and a half and, that stuff. But to see what the overall picture is with some of those of what projections versus reality.
yeah, the always with those things is trying to compare apples to apples, right? Because there's so many factors that go into an operator. It doesn't matter which asset class they're in. Their expertise, the specific geography they're in, the type of strategy they take when is it a value, is it value add development, what different share classes. Well, I was down this rabbit hole of like fees. The asset management fee of an operator, it varies from one to the other. It doesn't mean that this is correct and this is not. It's just a situation where, hold on, before we go and dive into this, let's first see if people really are interested in the fees or in the splits or in the expectations from a cash perspective. And be about private lending. What exactly in private lending would you be interested in? Is it
From 2022 onwards, as interest rates started going hiking, we stopped putting money in real estate. We actually shifted onto the debt side of real estate. So basically lending out against first lien position. Um, and so that's what I mean by private lending.
but direct private lending or through a fund?
No, through debt funds.
Yeah, that's an asset class as well. And I mentioned also it has went down over the past year, like we've in our but as an asset class that we can unpack more. Assets they lend to, what type of protections do they have in place, and are they leveraged or not? Fees, right? That type of stuff. That's correct.
Exactly.
Yeah, yeah, we can do that for sure. I know we're invested in a bunch of those private lending funds.
Yeah.
And Randy, with what Randy just wrote, yeah, sometimes the fees produce the highest returns, so usually don't care about fees. It
Randy,
is,
how do you know that ahead of time though? That's the of like, so there's a couple of mobile home park funds that I was looking at this last year. They're buying the same type of thing. They both generally the same level of experience. And one with significantly higher fees. And I agree completely. If I knew that the one was going to buy better deals, then I would. The fees, the fees, that kind of thing are peanuts compared to into the right thing. Do you operate it right? Can you execute on your plan? But ahead of time, how do you know? Or is it just you've gotten, this over the years and you get so therefore you don't care about their fees?
Yeah. So when it comes to fees and debt, I typically look at things fees and alignment between the GP running the debt fund and the LPs. So one funds we looked at, they don't take any points and they pay out a 10% pref and then a 50-50 split. So their alignment is very well aligned with the LPs because the LPs have to make money before they make money. So that's, I'm in fees and payout structures, and I would say alignment between GPs and LPs. That's always critical for me.
yeah. And Mike and I have decks from different funds, and it's also important on that front when you analyze a deal and they don't have any fees up front. If you open up the PPM or other stuff, like you go down in detail, sometimes, and I'm saying this is what you're talking about, maybe some other funds, there's going to be sort of like taking other methods. So it's very rare to find an operator who doesn't make any money until the pref. I also don't want them not to make any money until the pref. I think sort of they something, but anyway, it is alignment. And the 50-50, this is something that sort of when you about also there are very experienced operators and there are newer operators, and each experience and newer there's a different risk profile to them. And so the 50-50 or the 70-30, whatever the split is, should also reflect the risk premium you're taking investing with that operator, if a newer one or if it's a more experienced one. Usually the splits bet on a more experienced operator make more sense to pay preferred terms to the GP than the other way around. Right, Mike? Do you agree?
Yeah. Mm-hmm.
You don't like investing with newer ones, you like investing with sophomores, right?
Yeah, I've only in a few what I would call freshmen, because I knew them personally and I thought that they had, some they're not all bad, but some of my deals where I've been more worried about have usually been the freshmen.
Yeah.
So I tend to stick more to the sophomores and then the seniors, but I'm not going to get the same splits, because they deserve, given they've built the track record and it's safer, they go over and over, and so a little less risk there.
Yeah. I do have a question because Mark did write stuff here about what he sees as well. And, you know, I get like put mobile parks in a hard space, but I do feel like mobile home parks, I've been hearing a lot about. Every second investor wants to invest in a mobile home park. Do you think that's the next multifamily crisis? No?
Yeah, because the next, so the multifamily crisis, why part of why that came in is because they overbuilt, and it's not, and you ended up overbuilding. While you had the value adds that didn't necessarily make sense, there was value to add. They brought in floating rate debt, which then they happen to get crushed on that. But at the same time, you had other operators coming in and building new into the market. Versus mobile home parks, you have usually it's a 10-to-1 ratio of what gets, reallocated, used for industrial or something like that each year versus the new parks that come on. So I think mobile home parks are incredibly hard to get up and get in. And even when it looks like it's going to go right, I mean, the that I'm looking at right now of everything I've invested in was a absolutely gorgeous, love it mobile home park development in Bozeman, Montana, I mean, it's not yet, but I'm very likely going to lose all my money. And it's was that they're very hard to get them.
Yeah, so there's Mark, it's basically a small overall volume of mobile home parks compared to multifamily, right? And there's
Yeah.
still a need for the show demand. Yeah, B, go ahead.
Thank you. I tend to with some of what was said, but for me, I've stayed out of that asset class, especially as it's getting a lot more hot and I'm seeing a lot more deals because I've seen a lot of misalignment between what the GPs are doing in these mobile homes. Remember, mobile home earn money by renting the dirt. And I've seen a lot of these new GP, part of their business plan was to actually build up more homes and sell these homes to the resident effectively. And when you start thinking about how the economic flow is going to go, if you are an operator and you're trying to sell a home on some type of a mortgage-like scenario, you're probably going to be more motivated to make more money on selling the homes than you are going to be raising the rents on the dirt. And if you're invested in the park itself, your economic incentive is about rate hikes on the dirt, just like rent rolls going up in multi. So where I've had issues is not necessarily the asset class per se, but some of the deals in terms of how they're structured and the profit centers for the various different operators is where I have concerns.
I would take, I agree to some extent, but I would also take the other side of that, in that at least all of the operators that I invest with, there's none of them are trying to make selling the mobile home, the profits. They're usually break even, and sometimes they're even willing to lose a little bit of money, because when you get one unfilled pad, now it has a mobile home on it and it's now getting that rent. If you're at a fixed cap, you've created so much value in the property by getting your NOI up by that, $500 up that, let's say, you can charge now. But I agree with you. If you have somebody that's trying to make it a profit center and make most of their money off of that, that would be a misalignment. But infill is also hard. I mean, I think, I've seen a lot of times where there was a heavy lift and a lot of infill, and it's especially if they're not somebody that's really good at it and it has a proven track record, it's really hard to find the park homes, that you bring in. Transportation's hard. Getting people to come in and set them, getting them sold. I mean, it's a process. And so unless you've got a proven operator, if that's a huge part of their value add, I would just go into it, knowing the toughest things to do to add value to a mobile home park.
And about the question here about sort of different asset classes in the real estate space or assets like assisted living, storage, we see on Vyzer as well, not a huge amount compared to multifamily and industrial, but I'd say we have probably about 20 to 30 deals in each of them. It's just I don't feel comfortable relying any data points on that small number. Although if you guys think it's interesting even on that small data set, then we can definitely gather that information. But not enough to say I don't know, maybe Mike, if
I don't know. I'm not sure.
I mean, so I moved here from Israel a year and a half ago, right? And for me to see that many, storage every second, junction, blowing to me that's such a
Yeah.
successful asset class. Like I don't know it, but it's been successful, and I think people smarter than me probably believe it is, and so and a few as well. So I mean,
Yeah, I would
Which
say
submarket? Sorry, Litan. Litan, which
self-storage.
submarket?
So that's the
No,
thing,
no,
though.
just go ahead.
no. My question said you see a lot of them. Which market are you in? Like which geography?
I live outside of DC.
Oh, okay.
Sorry, Mike, go ahead.
Yeah, and that's what I was going to say is there are some markets where building self-storage is incredibly easy, and it's very easy for it to get overbuilt. And that's one of the risks with self-storage. They go up faster than multifamily, and usually and overbuild them quicker, and you can get in with it. There's other markets where it's incredibly hard to build self-storage, and so you really have to have a great operator that knows that. Yeah, it's of the asset classes that's easier to get overbuilt and to get yourself in trouble on something.
Yeah, go ahead, B. We're gonna last question, then we're gonna wrap up here. Okay, go. You're on mute, or maybe by mistake. If you
Sorry, no, I was trying to find the unmute button.
okay,
No, it was actually more of a comment. Typically, when I'm looking at getting into a storage, I look at the index, and it's like looking at supply, which is how many square foot of storage per capita there is, and the rule of thumb is below 7 is underpopulated, is underserved, and over 7 it is. But I know in different like larger markets like DC and everything else, or big metropolitan, that number isn't as much taken care of. But typically, when I'm investing in storage, I want to invest in the Midwest where I'm getting in at how much higher cap rates because I'm investing into a business and real estate and I'm looking for cash flow. Some of them go after Dallas or some of these crazy market. I don't want to be getting to storage at a cap 5. This is too much risk because it's a business and real estate. And that's why I prefer to do storage in Midwest markets where you can really look at the per capita and then determine, hey, is the market undersupply or over?
And 100% agree with you that the U.S. market is probably 1,000 sub markets, and each one operates differently. And I think Mike, you'd agree with that as well.
Oh, absolutely. Well, and I wanted to comment on what Mark said too, because yeah, I look at industrial outdoor storage differently than what I would say self-storage is. So self-storage, you're making an improvement and you can sort of overbuild it. I've yet to see a well-placed industrial outdoor storage space that you can overbuild it. I mean, typically that's not been built on yet, and there's not that much of it. And so to me, that's less because you can further and further out, but a lot of times people need it in more of a central location, city center type thing when you get into these major metro areas. So I don't think you have any of the same types of risks in industrial outdoor storage like you do with a built up self-storage unit.
All right, guys, listen, we're at time here. I'm respectful of that and sum it up. I really appreciate you all for joining. I'm going to share I'll let you know about a group chat, Randy, but regardless of that, I'm going to send out the recording and also a data sheet of all of our sort of market. And you'll also be getting an email about when the beginning of the year when we kick off calls. And I'm going to be reaching out to you guys as well to hope maybe even hop on a call with each of you guys and just get your input on what would be the most valuable topics to talk about, guests to, and make these as valuable as possible to all of us. But until then, I want to wish you all happy holidays. Thank you all for joining and have a great rest of your week. Thank you.